Welcome to this explainer, where we're going to dive deep into the financials of telehealth giant Hims & Hers to see if we're looking at a broken growth story or a completely misunderstood bargain. I'm really thrilled to take you through this because honestly, we're looking at one of the most fascinating trajectories in the digital health sector right now.
Think about it. We've got an investment that went from being a hyper-growth pandemic darling straight into a highly profitable powerhouse, only to suddenly drop a massive first-quarter loss on its investors. When a company's narrative shifts that dramatically, you really have to peel back the layers, you know? Is this a structural crack in their foundation, or is the market simply mispricing a temporary strategic pivot?
Here's our roadmap for today. We'll cover the 5-year growth machine, that sudden Q1 profitability stumble, the bull case, the bear case, their future catalysts, and finally, the final valuation verdict.
Let's kick things off with Section 1, the 5-year growth machine.
And when I say machine, I absolutely mean it. The company's top-line expansion has been meteoric. They scaled aggressively from just under $150 million in 2020 to a staggering $2.34 billion projected by the end of 2025. We're talking about average annual revenue growth consistently hovering near or even above 75% during that stretch. This wasn't just some pandemic fluke. The absolute dollar growth actually accelerated as the company matured, which, if you follow the industry, you know is exceptionally rare for direct-to-consumer businesses.
But here's the absolute kicker. That top-line scale turned deep historical losses into blowout 2025 profitability, generating $128.4 million in net income. By expanding their gross margins to nearly 80% in recent years, they proved they could absorb massive marketing costs. We're talking over $600 million in a single year, and still deliver genuine, fundamental profitability. They completely transitioned from a cash-burning startup to a cash-generating enterprise.
Which brings us right into Section 2, the sudden Q1 profitability stumble.
After 4 straight profitable quarters in 2025, Q1 of 2026 shocked analysts by swinging right back into the red with a reported $92.1 million net loss. That translates to an earnings per share of negative 40 cents. For a company that had literally just proven its ability to generate positive net income, this sudden aversion to heavy losses instantly tested the bullish narrative. It immediately made investors question how reliable those previous margins actually were.
So let's break down exactly what happened. Revenues flattened out sequentially, dipping slightly from $617.8 million in Q4 to $608.1 million in Q1. At the same time, gross margins compressed down to 65%. The primary culprit here? A $33 million restructuring charge. Management made a sudden strategic pivot away from custom-mixed compounded weight loss products, which forced a major write-down of their supply chain assets, alongside some elevated legal and acquisition costs.
Okay, Section 3, the bull case, focusing on sticky subscriptions.
So, with that sudden return to unprofitability, why are the bulls still seeing incredible long-term value? Well, they point to an undeniable moat: 2.6 million captive subscribers tied to highly recurring treatments. Unlike traditional telehealth models, think Teladoc, that rely heavily on B2B insurance contracts, Hims utilizes a cash pay model. Their core products in hair loss and sexual health are incredibly sticky. Treatments like minoxidil require continuous use to maintain results, which essentially creates a biological lock-in. Powered by an internal vertically integrated pharmacy network, the business still generated over $200 million in trailing free cash flow, which easily covers its accounting losses.
And then there's the map. When we look at their geographic footprint, supporters argue there is a massive, totally untapped runway for global expansion, with the vast majority of their 2025 revenue, $2.21 billion, still concentrated domestically, and just $134 million coming from the rest of the world. The international market is basically a greenfield opportunity. If they can replicate their U.S. success abroad, the top-line ceiling is just staggering.
Now we need to flip the coin. Section 4, the bear case and regulatory risks.
Skeptics are really stress-testing this model. We can directly contrast their impressive consumer brand loyalty against their core vulnerability, a complete lack of underlying intellectual property. Because Hims & Hers relies heavily on off-patent generics and compounded formulas, they just don't have patent protection. This forces them to maintain massive marketing budgets to defend against copycats. But worse, it invites fierce big pharma litigation and heavy FDA scrutiny over their compounded drugs, especially in that hot weight loss space.
The bears are also heavily flagging the balance sheet. Historically, Hims operated with almost zero debt, right? But they've recently seen an absolute explosion to $1.12 billion in debt. Add to that the shrinking operating margins as they fight an intense marketing war for market share against well-funded rivals like Roe, Keeps, and Teladoc. The big fear here is that they're stretching their leverage to fund inorganic growth, right at the exact moment regulatory heat is turning up.
Moving on to Section 5, Future Catalysts and Expansion.
To combat these risks and actually hit their raised $2.9 billion revenue guidance, management is executing a really clear three-part roadmap. Step 1, transitioning to safer branded weight loss drugs. Step 2, deploying AI tools like Labs AI and MedMatch to lower provider costs and personalized care. And Step 3, they're spending up to $1.15 billion to acquire Eucalyptus, an Australia-based digital health company, to aggressively scale their international footprint into places like the UK, Germany, and Japan.
Execution is the name of the game, and this strategic pivot is already showing massive scale. Following their transition to a branded GLP-1 portfolio, the company fulfilled 125,000 Wegovy shipments in just 6 weeks. That sets a blistering pace, equating to roughly 100,000 new subscribers a month in the weight loss category alone. It really proves that their marketing funnel and platform can absorb and pivot massive consumer demand almost instantly.
Finally, let's tie this all together in Section 6, the final valuation verdict.
Ultimately, how do we value this complex mix of hypergrowth, debt, and regulatory pressure? Over the past 5 years, the stock has been on a wild ride. It evolved from a highly dilutive startup in 2020, transforming into a cash-generating machine by 2024. They even initiated a $135 million share buyback. However, 2026 marks a distinctly riskier chapter. They're relying on debt-fueled acquisitions and facing purposeful margin compression as they scale globally. In fact, management explicitly warned that net income profitability might not return until 2027.
When we anchor to the hard data, Hims trades at roughly a 2.4 times price-to-sales ratio. This places it in a really fascinating middle ground. It's significantly cheaper than direct telehealth and direct-to-consumer peers who average around 4.3 times sales, but it is twice as expensive as the traditional legacy U.S. healthcare sector at 1.2 times. The market is basically pricing in their superior growth and margins, but clearly applying a heavy discount for those regulatory and compounding risks.
This creates such an interesting tension for anyone evaluating the stock. While current prices are hovering right near traditional analyst targets of around $26, discounted cash flow models, which are running off that incredible $209 million in free cash flow, imply the intrinsic fair value could actually be anywhere from $28 to over $66 a share. If they can navigate the regulatory minefield and maintain that cash generation, the upside is potentially massive.
So looking at the incredible growth offset by sudden losses, debt accumulation, and serious regulatory heat, you have to ask yourself a question. Are you just following the crowd, or are you stress testing the numbers to build your own thesis? Hims & Hers is building a phenomenal consumer flywheel, but it definitely requires an investor with the stomach for near-term volatility. Thanks for joining me on this explainer, and keep questioning the data.